Today's guest is Mike Cagney, the co-founder and former CEO of SoFi and the founder and CEO of Figure Technologies, which recently went public on the NASDAQ with a $7.6 billion valuation. We're excited to have Mike on the show to talk about this huge milestone and what it means for the future of FinTech, blockchain-enabled lending, and how technology is transforming access to credit and financial services. Mike, welcome to the show.
Thanks for having me.
Of course. So the first question we like to ask our guests is, what does crypto in America mean to you?
So I think what it means to me is really an overhaul of the capital markets. And, in particular, the superpower of blockchain is the ability to create native digital assets on chain. And that changes the way we transact. It changes the way we lend. And, if you think about the US capital markets, they're really markets that require trust and therefore intermediation, right? So, I always use the example, when you trade stock, there's 7 people that sit between a buyer and seller. When you swipe a debit card, there's 5 people that sit between a buyer and seller. When you borrow money, you're borrowing it from a bank who's aggregating that from a depositor, right? There's all this intermediation. And so blockchain has this incredible ability to move that to just bilateral transactions. And when you think about who gets disintermediated out of that, you're talking about trillions of dollars of market capitalization that, can accrue to the blockchain and to the technology. It accrues to the users, in particular the consumers, which creates a great leveling aspect. So I view this as sort of a once in a generational technology, and it will be responsible for the reallocation of more public market cap than any technology ever has in the history.
So, Mike, I want to get into the IPO. Congratulations again. I was digging into this a bit, and I think you may be the only founder to have gone public with both a traditional fintech company and also a crypto company. So, previously you started SoFi in the consumer lending space, and obviously now you're at the head of Figure. What did you take from consumer lending and the business that you built at SoFi that you brought over to this space, and why do you think it works so well?
Yeah. So, when we started SoFi, the real premise behind it was connecting sources and uses of capital, right? Which is sort of the premise of blockchain. And we had this idea that we could get alumni to invest in the loans from students in the school that they went to. And it would make the sense because there was an affinity connection. There were all these other benefits to disintermediate the bank or the lender as an allocator. And we were a victim of our own success. So the demand for the loans far outstripped our ability to raise capital for the alumni. So, we ended up being more of what I would call the FinTech 2.0 model, relying on the wholesale capital markets. And when we started Figure, we had to do the same thing. So we started as a direct-to-consumer originator. We were out acquiring customers. We were using our warehouse financing from Goldman and Jefferies and others. But we were doing it on chain, and it set a foundation for us to actually build into, sort of the 3 value props of blockchain, which was first, we were able to capture transactional efficiencies, reducing the cost of third-party review, for example, for securitization. We were able to create liquidity. Now, this mattered a lot because very quickly we went from a direct-to-consumer model to a business-to-business consumer model. So we have over 170 third parties today that use our technology. They originate loans. The loans are on blockchain. That includes 10 of the top 20 mortgage companies. And what we've been able to give them because of blockchain is a liquid marketplace where they can sell forward that production just like they do with Fannie Mae and Freddie Mac. So we're the first to stand up a liquid capital market for private credit. And that is because of blockchain for a host of reasons we can go into. But the big value prop for me, sort of the third leg of the stool, is DeFi, the ability to finance. And I'd always been very envious when I started Figure of, what Stani built at Aave. And I'd look at this and I'd be like, I don't understand how people are borrowing against their Ethereum at 6.5% on Aave, and I'm paying, SOFR plus 250, which is 7.5% at Goldman. Like, why aren't I getting the cheaper financing? And, it dawned on me pretty quickly. It's sort of this classic Pareto condition, right? When you connect sources and uses of capital, both sides are better off because the entity that sat in the middle collected so much rent that by taking that rent away, you can significantly improve the situation for both in this case, borrower and lender. And so we stood up a marketplace we called Democratized Prime, where initially we did this for our crypto exchange. So we run a small crypto exchange. It's really for R&D purposes, although we do care a lot about it. And you can buy on margin in that exchange. And when you buy on margin, you're borrowing from the community through this Democratized Prime construct. But what we started doing more recently that's really important is we started bringing loans over to Democratized Prime and financing them there. And we brought $10 million over, and sure enough, we financed it cheaper than we could have through the street. We brought another $10 million over, did the same thing. And so we're starting to build into this structure around DeFi. And this goes to the whole root of all the way back to the genesis of SoFi, which is that allows people with capital to invest directly to people that need capital with no intermediation. And that ultimately is what the most powerful thing about blockchain is, at least in my mind.
Mike, you mentioned, I guess we all mentioned at this point, the figure went public last week, had a massive debut with the stock jumping 44% on its first day, well above the IPO price. Were you kind of expecting that level of investor enthusiasm? And then also, why did Figure want to go public? How long has this been in the works?
Yeah, let me talk about the latter first. I think there were two big drivers for us. Well, one is, I think while blockchain certainly is going to have a lot of disruption in the marketplace, right? I think it will change how we trade stocks. It will change how we swipe debit cards. There's even more greenfield opportunity, like what we're doing in credit, which no one's ever done before. So it's not like we're disrupting a market, we're creating that market and creating a huge amount of value as part of that. And that greenfield is really what attracted us to lean into this. And so, I believe that just like we have a Magnificent Seven in Web 2.0, we're going to have something like that in Web 3.0, right? I don't know if it's 5 companies or 8 companies or whatever it is, but it is such a profound and important technology that I think we are going to have that analogy. And we wanted to be part of that mix. We wanted to help tell that narrative, and the public venue gives us the ability to do that, right? What is a successful public blockchain company using public blockchain? And that IPO process allows us to do it. The second thing that isn't lost on us, when I was running SoFi, we raised $1 billion from SoftBank, and it was the largest private capital raise anyone had ever done. And Masa was very interesting because I only wanted $200 million, and he's like, "You're going to take $1 billion," and I said, "I don't want $1 billion," and he's like, "If you don't take the
want
billion,
$1 billion.
So if you don't take the $1 billion, I'll give it to your competitor." And I said, "Well, I don't want that, so I'll take the $1 billion." It ended up being one of the most important strategic decisions we made, because that ability to have that on the balance sheet allowed us to take risk and move faster than any of our competitors could. And I think it's a big reason why, there's such a gap between a SoFi, for example, and a Lending Club or a Prosper, some of the other lending companies that started at that time. And we felt that there was a situation here to do that as well. There's capital out there. There's the ability for us to lean in and take that capital down. Now, we didn't take down as much as we could have, and there's a very specific reason for that, which is, we plan to do a fast follow, or hope to do a fast follow second QSIP native on blockchain. We can talk about that in a minute because I want to answer your entire question. But we felt that there was an opportunity to take that capital off the table, and it would be a big differentiator. And now I forget the first part of the question. This is the problem when I answer the second part first.
It's okay. The first part was on the note of the stock jumping 44% on the day, which was above the IPO price. Was that kind of an expectation given what we've seen with other crypto IPOs, or how did you feel about it?
Yeah, so it was interesting. We had a massive amount of retail demand, and I think I gave more to retail than any IPO has ever done. I don't know that for certain. I think it's certainly what the bankers were complaining about, because they don't, they're not as big of fans of giving allocation to retail as they are to the big institutions. And that was important to me because I wanted to get broad distribution and ownership of the stock. And, given the significant oversubscription from retail, we felt that there would be some demand. It would potentially push the stock a little bit higher. We did not want the stock to go up, 5x or whatever that case is. I always draw the analogy to Airbnb. It's never actually traded up to the price it traded on day one of trading, right? And, when you have those situations, a lot of times the banks are basically squeezing retail and then providing a medium for the institutions to flip out. And, that, again, is sort of orthogonal to the whole premise of blockchain and this democratization, leveling the playing field. And so we were very specific that, we wanted the stabilization agent, which is managing that liquidity and that day one trading, to do what they could to keep it, within range.
Yeah, Mike, you mentioned a little bit about the fundraise, but can you give us an idea about how you might use that capital to help Figure's growth and adoption now that you guys are public?
Yeah, so Figure's in a little bit of a unique situation in that we are profitable. We've been profitable. We were profitable last year. We're profitable this year. We're accreting cash. It was actually we were on the roadshow pitching it. Someone actually yelled at us for being profitable. Like, well, why aren't you investing all this in growth and blah blah blah? And it's like we don't optimize for profitability. It just drops out of the equation, right? And so we have revenue, we have expenses, and then it turns out there's some left over and there's profit. What I think we can do is use the balance sheet to seed out these democratized prime marketplaces. So as we bring more product onto democratized prime, for example, stock to borrow against, we can be first capital in those marketplaces with our balance sheet to kickstart that. Day one capital is always the hardest capital. And if you can drop $5, $10, $15 million into a marketplace to get liquidity, get a process moving, it tends to attract capital. And so I think that's really the at least as it stands, the current number one use for those proceeds. Certainly we're in a subscale industry. There could be acquisition opportunities. We don't have anything specific on the table right now. We're always open. We get bombarded by people pitching us concepts, and we're always listening. But that's not the primary objective. I think it's really just to use the balance sheet to kickstart a lot of these demo prime marketplaces.
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to Gemini.com/CIA to learn more. Terms apply.
Mike, I think it makes a lot of sense to use that capital to obviously go out. You made decisions as a public chairman before and go out and try to acquire some of these companies. Crypto is a bit unique in that it's far more volatile than like a Stanford student's kind of student loan, right? Like the prediction of payment there seems to be pretty stable. How do you think about volatility in this space from your perspective as someone who's been in lending this long?
Yeah, I mean, it's volatile, but it's also liquid. And I always draw the example. I've been lending against property since we started Figure back in 2018. And in general, our loans have performed very well, but there's loans we've lost money on. And for whatever reason or purpose, I've been lending against Bitcoin since 2020. I've never lost a dollar because I can set the advance rate at a level that's commensurate with the amount of volatility that you have. And that really is what I think is so interesting about DeFi, because in DeFi, you can look at, do I have perfection of the asset? What's the liquidity of the asset? What's the volatility of the asset? And what's the over collateralization? And that's what you're driving your lending decision on versus actually underwriting the underlying credit, which you can still do. And obviously you would want to do that to make an assessment as to your assessment of volatility, whether it's accurate or not. But it's really allowing you to move to more of an asset-based lending structure because you have a liquid capital market. And that's why, for DeFi to work, you have to have a corollary for that collateral of a liquid market to trade it, to know that if you have to close and liquidate, what your potential haircut's going to be on that transaction.
The company also did about $6 billion in home equity loans in the past year, which was up 29%. Mike, what kind of factors drove that growth, and how sustainable do you see that being in the coming years?
So one of the cool things about being on blockchain is you can go and look and see how many loans we did in July and August and as of September 15th, and not wait for our quarterly earnings to come out. And this is an interesting dynamic, with the regulators around this, because normally that would be material non-public information, but we're on a public blockchain, right? And so all that information is actually there. And, you can see that, the July and August numbers are over 50% year over year growth. Like our growth is accelerating, not slowing down. And we expect that's going to continue. The growth isn't gated as much by demand as it is by us having to manage the capital market and make sure that the guarantor, which is providing, certain liquidity, is growing commensurate with that production. What we've been doing more recently is expanding from a traditional second lien HELOC into first lien mortgage using the HELOC. And that's now 20% of the volume of what's going through. And we expect that's going to continue to grow. So it's the largest private credit marketplace, on any given year, $2 to $4 trillion of mortgages are originated. If we're doing $1 billion a month, we're a tiny speck in that giant pool. So, we would say there's an enormous amount of upside for us.
Mike, you talked about something early in your response that I want to ask about too, because I feel like this is something that, regulators and or investors are going to have to deal with now, is like the reality that what you guys provide is available on the blockchain now. And so we have this information from July, August, et cetera. And like you said, we don't have to wait for the earnings in, like, let's say Q4. People could just look and kind of like make a decision based off that. So what is kind of the dance or relationship you have to have with regulators on that front to make sure that it's not a problem? Or is it just like, hey, on the blockchain, sorry.
It's education. I think the key is that you want uniformity of people's access to that information. So what we're doing is standing up, some education for analysts, for example, to be able to all get that data at the same time and in a fair and accessible way. The reality is that the data is real time, and it's 9:49 right now in New York City. I can go online and see every loan we've done as of 9:49 today, as well as every loan that's paid us as of 9:49 today, right? And that level of real time data affords liquidity. I remember back in 2020 when we went into the COVID lockdown, and there was a mortgage moratorium that was put in place. And basically private credit stopped trading because nobody knew, are people going to pay these loans or not? And everyone was waiting for Fannie Mae and Freddie Mac to put their remittance reports out, which would be about 45 days from that point. And some funds figured out pretty quickly, hey, Figure actually has real-time remittance reports. And they started buying our loans and buying our bonds to get access to that data and, to basically know exactly what was going to come out down the road and allow them to take positions in the market. And that, so our credit stayed liquid in a period where everything was illiquid. So, again, going back to the value of blockchain, having truth and transparency, real-time transparency, really supports the construct of liquidity.
It's funny that we're talking about this now. I saw a headline pop recently, this morning actually, about President Trump saying that companies shouldn't have to report every quarter. And it just made me chuckle because it's like, okay, maybe with blockchain they won't have to, right? It's going to be all there.
Yeah, well, it'll be continuous. It'll be continuous, and I'm sympathetic to his position. It ties into the whole genesis of the long-term stock market or long-term stock exchange, which never really took off, I don't think. But the idea, I've always pointed out in all our investor conversations, I'm extremely proud of our team. The way they've been able to operate, the profitability that drops out of the business, but the $339 million of revenue last year and $101 million of EBITDA are basically inconsequential to what the opportunity is you're building into, right? And so you can be myopic to the quarter-over-quarter information, and it's not that we don't care about it, but we are very focused on the longer-term opportunity of massive value creation. And so I think, the construct behind the 6 months was to afford more of that thinking. I don't know that it's that different, going from 3 to 6. And, certainly with blockchain, I like the idea of everyone running their ledger on chain where it's continuous real information, right? And you're not waiting for these discrete events and you have certainty. I think some people would argue, well, that's going to create more volatility. I would say that actually reduces volatility significantly.
On that note, just of identifying another new thing sort of out of DC, I think we're just inundated these days with updates, whether it's from a regulatory agency or legislators or, the president, the administration themselves being more pro-crypto, getting Genius on the books. How have you seen the regulatory shift in Washington change the way you guys deal with banks, mortgage companies, sort of the TradFi space in engaging with you and Figure? Like, did it all kind of pick up at once, or was it sort of a slow evolution over time?
Yeah, so we've been working with our banks, like Goldman, for example, using a platform we have called DART, stands for Digital Asset Registry Technologies, and it basically does a UCC Section 8 encumbrance to the blockchain asset, and we've been using it in our warehousing. And, I wanted to go to market with this and talk about, hey, this is great. You're on blockchain, public blockchain, you're using it, last year. And they were like, absolutely not. Like, our regulators would never allow for any of this. If you ever go on a podcast or a conference and talk about it, we're going to disavow you and it. And I was like, all right, I'll never talk about it. Literally after the election, I got hey, let's do that press release and talk about how we're doing all this cool stuff on blockchain. And I'm like, all right, that's great. I think the change in the SEC around the elimination of enforcement as a policy tool is really the biggest thing that's happened thus far. And I think that gives us a lot of comfort to lean in when we feel very confident about where we are in terms of the regulatory side to do new stuff faster. I feel like we had a lot of constraints and a lot of headwind over the last 4 years. In fact, I can't imagine a worse regulatory environment than the one we had in the last 4 years, right? And so I think we're in a much better regulatory structure now, and I feel very, very happy about that. I think Genius Act, certainly by legalizing stablecoin, provides a foundation for the development of stablecoin infrastructure for payments and all these other things that have we've long waited for but weren't possible because we couldn't get the banks involved. The Genius Act has a second order impact to the banks around their deposits, which I think is profound and significant, has significant blockchain applications as well. And I'm happy to talk to that. I think clarity is a harder one, and what I'd like to see in clarity is really a codification of DeFi living outside of certain regulatory regime. Chairman Atkins has taken that position verbally, but that is his position, and another SEC commissioner could reverse that position. So I'd like to see codified legislation protecting decentralized finance. The way that he's articulated it should be protected.
Mike, you just mentioned other blockchain applications, and I wanted to ask you've said in the past actually that, the long-term potential for blockchain is through these financial applications, right? And how we apply these solutions to existing real-world problems. Are there new areas beyond mortgages where you think Figure could help and explore blockchain uses beyond just the mortgage stuff?
Yeah, I mean, there's two that I'm really excited about, and excited might be the wrong term. The two I'm enthusiastic about. One is that second order impact on the Genius Act. So, the Treasury's out talking about the trillions of dollars are going to flow into stablecoin on the back of the Genius Act, and I believe they're right. I think that will happen. There isn't a lot of discussion as to where that money is flowing from, and I believe that will come out of bank liabilities, bank deposits. And, in 22, when the Fed started to tighten into 23, bank deposits went from 18.2 trillion to 17.2 trillion. So we had $1 trillion of outflow, and the capital markets completely shut down. The banks began to sell assets at fire sale prices. Silicon Valley Bank failed. First Republic failed. The Fed, and in particular the FDIC and the Treasury, had to step in with extraordinary measures to keep the market from falling off a cliff. That was $1 trillion of outflow. So they're right, and it's 2 trillion, or, they did a study saying 6.6 trillion. Something has to step in and fill that void. I think that can be DeFi. I think this is the opportunity for DeFi to step in. What we're trying to do with our loans and why it's so important that we're bringing them over to democratized prime is we're showing a roadmap for a bank to be able to originate a native digital asset on chain, get the transactional efficiencies, get the market liquidity, but most importantly, get the financing, right? And be able to use that to offset any potential loss of liability on the balance sheet side. So, I'm going to go on a roadshow and talk to as many bank CEOs as I can about this is how you mitigate what is coming, because it is coming. The second thing that I am, I guess I can say I'm excited about is I would like Figure to do a second QSIP now that we've gone public, where we do a blockchain native security, not a DTCC security. So, everyone's talking about tokenizing DTCC with security. There's a whole bunch of reasons why that won't work unless you get specific SEC preemption. But even without the SEC air cover on it, which I'm not sure you're going to get, it still isn't really blockchain because the security isn't on the blockchain. It's still an IOU, right? You're still trusting DTCC, and the whole premise is we shouldn't have to trust anyone. So I think there's an incredible opportunity to be the first to do a blockchain native public equity. We already have the first public security on blockchain with Yields, which is our stable coin that pays interest, but we would do this on equity. And the cool thing about this is there's going to be some transactional efficiencies off of this. There'll be some liquidity benefit. You can trade it 24/7. I don't actually know how valuable that is. I was bidding to lift FTX out of bankruptcy, and I got to see their perp business, on the stock side, and it wasn't like it was ripping, right? It was relatively modest in terms of what they were doing. But what is valuable is bringing that stock into DeFi. So being able to use it as collateral to borrow to buy Bitcoin or vice versa, the cross-collateralization aspect, and also cussing that stock yourself and managing your own stock loan. Because today, when you lend stock out and it goes on special and it goes from Fed funds up to 40%, your prime broker is clipping most of that. And so if you control the borrow, you get it. You get the economic, you control if you borrow and how much you charge for it and so forth. And that I think is really powerful. And that's something that really resonated when we were on the IPO process with a lot of the buy side firms that we were talking to. They're like, yeah, we want this. This is great. And that security can be totally fungible to the NMS, the national market security. And so the premise is, well, why wouldn't you own the one that you control versus the one you don't, right? They're convertible one to the other. They're not going to drift in terms of price or what have you. I think there's ways we can get market making liquidity on the other side. So this is going to be a big effort for us and something we're going to lean in on and try to get done before the end of the year.
Mike, I'm very curious. You just covered a lot of ground in terms of the historical sort of ups and downs of the industry, the Fed's role back in those bank collapses, obviously seeing some of the stages, in cycles that you've seen. It's a pretty prescient sort of week to be discussing this. How do you think that interest rates and the Fed are going to affect both sort of your business in the short and long term, and then also just the state of the macroeconomy sort of overall?
Yeah. Look, I mean, it's an interesting time for them to be cutting rates because it is a proactive strategy. Some could argue it's overdue, and I think there's legitimate arguments on both camps. It certainly helps us because as a lender, lower rates are always better. They reduce borrower debt cost and debt to income ratios and so forth, and so it's something that we can lean in and take advantage of. I think from a macro standpoint, it'll be interesting to see how it impacts Bitcoin. I think that the correlation between rates and Bitcoin and gold, that historically has been, certainly on the gold side, historically has been relatively strong. I think that's broken down to a degree. So we'll see, how that happens in that premise. But certainly the ability to reduce borrowing costs is going to be important for everyone. And so it will be a net positive to I think most of the things that we do.
Yeah. And Mike, before we let you go, we always like to wrap with asking our guests, aside from everything we've discussed, what is something else that you're watching right now in DC or in general that you think others should pay attention to?
Yeah. I think, as I said, going back to, and we already talked about this, so I'm not going to give you that unique of an answer of what I'm watching. I'm spending a lot of time looking at Clarity. I avoided DC for the last 4 years because there was no upside to be there. And, it would be unfortunate if you crossed the street and a regulator caught you and got to talk to you about stuff. There's no, in the context of where you're trying to build a life of call options, that was a put. And so, that's changed now where we're trying to be in DC a lot more often, a lot more engaged in the dialogue and discourse. I think the Genius Act was one where there was general alignment. I think the banks felt they got bamboozled a little bit because Coinbase is paying interest on USDC deposits. And so it is de facto paying interest, right? And the banks didn't want that and didn't realize that was actually a thing. And now they're trying to amend the legislation. I think it's going to be very difficult for them to do that. But that it was a unique act that generally had the right support. Clarity is much more controversial, even within the crypto community, right? So I think there are centralized exchanges that are completely orthogonal to the premise of the decentralized exchanges in terms of what they want out of this. And then there's the TradFi constructs, the NYSE and the NASDAQ that have their own ambitions as to how crypto should trade and what it should look like. And so I think that this is going to be much more contentious, just even among the groups advocating for it. Let alone the opposition. There were some Democratic lawmakers that put out 7 points or 7 principles they felt had to be adhered to as part of Clarity. last week, and some of those are challenging to the spirit of what we in the crypto industry want out of the bill, and none of them mentioned DeFi. So I think it will be very interesting to see how that unfolds, and I think that's going to be a much more of a fight, and much less certainty that comes to fruition than Genius was. But to me, that's a really important thing for the industry to see how that evolves.
Yeah, for sure. That's something we're all paying attention to as well. Mike, thank you so much for coming on today. It was a pleasure.
Oh, thanks for having me. I really appreciate it.
Thanks,
Thank you,
Mike. And congrats again.
Thank you.